Welcome back. Well, it is definitely a subdued day for the markets at this point in time. So let's get in some analysis in terms of specific sectors. Time now to put the spotlight on our earnings special segment, Quarter Se Quarter Tak. We kickstart the results season with IT, and here's a throwback at the quarter gone by and how the sector closed the final quarter of FY26. Reema's here to tell us more. Reema.
Thanks so much for that. So let's begin with the top highlights of this quarter. First, in terms of price action, the Nifty IT index was down 24% in the Jan to March period, which compares with a 14% decline in the month for the Nifty. So underperforming in Q4, and this underperformance comes on the back of a 22% underperformance last year. That said, the price action in March was far more resilient. In the month of March, while the Nifty dropped 10%, the IT index was flat. The question is, does that suggest that much of the pessimism may be priced in? The second is terms of news. There was so much news flow which impacted IT. First, it was AI fears of the industry going through obsolescence. Then the West Asia conflict, whether there are going to be some second-order impacts on discretionary spending by large customers. And third, and that's a big one, the INR depreciation. The INR, on an average, fell by 2.5% to 3% against the dollar on an average. And if you look at it point to point, December 31st closing to March 31st closing, the INR was down 5.5% against the dollar. What also happened in the quarter was the great valuation reset. This is some very interesting analysis done by CLSA, where they say that, look at this, for a company like TCS and Infosys, the PE contracted by nearly 20-25%. But if you look at the EPS downgrades, whether it's for TCS, HCL Tech or Wipro, were fairly modest. So what happened basically in the quarter gone by was that the valuations contracted very sharply. And now with this, the valuations for the Indian IT on an average are at 17 times forward consensus, which is below the 5-year pre-pandemic average of 18 times. So just put all this together and to run you through the expectations for Q4. While Q4 is expected to be a very modest quarter, the focus will be on FY27 guidance and the impact in terms of rupee. Now coming to the revenue expectations for the current quarter. As I said, very modest. For TCS, it's expected to go by 1%. That's on account of the Coastal Cloud acquisition. The Harman acquisition will benefit Wipro this time. While for Infosys and HCL Tech, we can expect a slight sequential decline in the revenue growth on a quarter-on-quarter basis. Mid-caps are generally likely to perform a lot better. So whether it's Persistent, Coforge, Emphasis, Persistent could lead with a near 3.5-4% kind of a top-line growth. But all attention will be on the FY27 guidance. It's going to be a cautious but a stable start. For Infosys, again, there is going to be a benefit of acquisitions, whether it's Versant, the two recent ones that the company closed, Optimum Healthcare, Stratus Global. So on an average, expectations are for a 3 to 5% revenue growth for FY27, with Infosys maintaining margins at 20 to 22%. For HCL Tech, expectations are either 2 to 5%, some are at 3 to 6%. But the question for HCL Tech is, will they raise the EBIT margin guidance back to 18 to 19%? For Wipro, again, revenue expectations are very, very modest, but here the street attention will be on a potential buyback. But the other big story is the INR depreciation. It's acted as this invisible tailwind, a critical safety net. So what happened is brokerages have downgraded the revenue estimates. For revenues, street is working with a low single-digit, mid-single-digit kind of a top-line growth. But EPS estimates have gone up on account of the rupee. And they've gone up by nearly 4-5%. And for many of the companies now, the EPS estimates, the EPS growth for FY27 is actually now seen in double digits. So just to wrap this up, what will we watch? The global GDP and discretionary spending, because GDP forecasts for many of the developed nations have come down, which means that will this put tech spending on a bit of a leash. Secondly, the AI adoption cycle. We're currently in the deflation stage where AI is compressing the current revenue for the Indian IT companies, but the street is looking for signs of reflation, where the benefit from AI actually offsets the decline on account of AI. Third, the margin trajectory on account of the currency tailwinds. How much will the companies retain? How much will they look to reinvest? And finally, capital returns. As I said, especially on account of the buyback changes, Wipro particularly is a candidate for a potential share buyback announcement.
All right, take that point, Reema. Thanks a lot for that. Whether there is a buyback announcement for Wipro or not, along with all the other things that we'll be tracking in the IT space so far. Cautious but optimistic is the view. Modest guidance is what the street is expecting. Abhishek Pathak, the IT and tech analyst at Motilal Oswal, joins in now. Abhishek, the sector has been obviously after a very long period of underperformance over the last month and a half, has been trying to find its feet. The IT index actually this month is the best performing index. It's up around 7%. Do you think a lot of the weakness is in the price? And what are your expectations from this earnings season? Which ones do you think could surprise on either side?
Yeah, hi, morning, and again, thanks for having me. So I think my perspective is the last couple of months have been extremely, volatile, and it's all been driven by a lot of narrative shocks that the sector has to endure. 4Q from that perspective would be, fairly range bound. We've got a very narrow range of guidance to contend with in 4Q, so I don't expect a lot of surprises or misses in 4Q. But whatever price action you've seen in the past 2-3 months is a result of not what's going to happen in the next couple of quarters, but the anxiety around what's going to happen, let's say 3 to 5 years out. And from that context, I don't think the industry today even has any easy answers to that. The two key overhangs, right? I mean, war and AI deflation. I don't expect them to have a major impact on 4Q revenues. But like I said, I do expect the second order impact of a war to kind of weigh on guidance and commentary a little bit. So we do expect guidance, at least the lower end of guidance ranges for most large caps, to be just slightly cautious to account for any impact of the war on deal win rates. But otherwise, the de-rating that's happened, it's probably around what happens 3 to 5 years out and what AI is capable of doing, let's say 5 years out, and 4Q might not have any easy answers for that particular problem.
Okay. All right. Abhishek, just based on what we've seen in the month of March, specifically when the West Asia conflict began, the fact that the Nifty IT index is flat versus the Nifty, which is down around 10-odd%, I'm sure a lot of clients are asking you that, is the worst over? Is this a good time to possibly buy? What are you recommending?
I think it's funny, right? I mean, the last since February, since Anthropic kind of came around and announced, a slew of releases, we've not seen EPS cuts then. Despite that, we've seen a massive derating. And, in the month of March, when Nifty IT has been fairly resilient, we've not really seen EPS upgrade outside of the currency, right? And I think trading on just the currency is a bit precarious because you never know when that trade kind of, reverses and, you're stuck with, something that's not very palatable. And from that perspective, I think the only key trigger for us to kind of, look at the sector is growth. And so far, at least our estimates around 27, 28 don't really point to significant acceleration. Largely because not just AI deflation, but also the war might have some impact in the short term around win rates. So while the valuations have corrected, tough to say whether this is an entry point which kind of has a positive trigger with regards to the IT index. But yeah, I mean, at least the huge shock that we saw in the past couple of months, I think looks like that's kind of behind us for now.
Right. What would your top picks be, and what would your top avoids be?
Yeah. So I think in terms of top picks, the framework we're currently using is, we like bottom-up companies which have good deal visibility and good exit rates for 4Q. So amongst large caps, we like HCL and TechM as our top picks. But we do believe that, for the first time in the last 5-6 years, we're actually getting a lot of good quality IT mid-caps, at large cap valuations, right? I mean, these mid-caps have consistently outperformed large caps over the past 7-8 years, but they've always been somewhat prohibitively expensive. I think right now we are in a situation where you are getting these quality names for valuations which are at 17-18 times forward earnings. And in that context, we do believe that stocks such as Coforge and Infosys offer excellent value, and they actually offer great entry points, because we do believe that even if AI deflation is to kind of come in and shake up the sector a bit, the mid caps are in a better position to pivot and kind of change their offerings and change their delivery models far faster as compared to large caps. So just to summarize, HCLT and TechM and Coforge and Infosys on the mid cap side.
Okay. Quickly, Wipro made that announcement with regards to that acquisition of Mindsprint. How would you read it, and what is the trajectory in terms of, acquisitions that or maybe expenditure of cash that you expect from IT companies in the next couple of quarters?
Yeah, I do expect M&A activity to kind of be very, very punchy, and I think it's good because it's easier to acquire capabilities inorganically, especially in such a fast-changing environment. Wipro's M&A, of course, is slightly different. Not the Herman one, which was again capability-based, but Mindsprint seems to be kind of a cost sort of takeout sort of acquisition, right? I think it's great for revenues. I think on the margin side, it may have to. I mean, it may be a bit difficult to kind of extract positive margins, especially in the short term. So I do expect some margin dilution from that acquisition in the near term. But long term, maybe over 7-8 years, the acquisition may turn out good. But yeah, I mean, TCS, Infosys, HCL, even the mid caps, I do expect them to be kind of fairly active in the acquisition market in the short to medium term.
Just a out of left field sort of question, Abhishek. Do we have any AI related play in India? Something that can actually grow? Is there any ancillary play, or is there any company that is doing something which may be an investable idea, given the sort of surge that we're seeing around AI, the interest around AI?
Yeah, I think it's an interesting question. I guess, the way I'm looking at AI, of course, like you said, one is, of course, the IP around AI, whether it's LLMs or whether it's sort of, having a wrapper around with LLMs and giving services to clients. And the other is the AI ancillary play, which honestly is out of my purview as an IT analyst. But keeping to kind of the AI IP play, I do believe right now the small to mid IT services companies who can build their IP on top of an Anthropic or a Palantir or an OpenAI seem like the best bet, because we don't really have a concentrated IP play in the near term, as far as I'm concerned. So I'll be watching the space for more companies, but for now I think we need to kind of look at the ancillary plays a lot more.
Okay, all right. Abhishek, we're going to let you go on that note. Thanks very much for joining in and speaking with us and setting up what we can expect from the IT companies in Q4.